Your rent is going up, your paycheck is buying less, and the government keeps telling you the economy is fine. Then the Federal Reserve cuts rates again, like that is supposed to magically fix everything. Here is the part nobody wants to say out loud. The rate cuts are not really for you. They are for the system that protects capital when the world starts slipping. This is not financial advice. This is financial education, because if you do not understand the mechanism, you cannot understand why you keep getting crushed while markets keep rising. In 2026, you are living inside a machine that converts your anxiety into obedience. You are told to hope the next cut will help. You are told to wait for a recovery. You are told the housing problem is temporary, the inflation story is over, and retirement will work out because the same politicians who broke it will fix it later. But money does not run on speeches. Money runs on incentives, and the incentives are brutal. In this video, I am going to connect four realities that most people keep separating like they are unrelated. First, the Federal Reserve's rate decisions and what they actually do to ordinary households. Second, the long, quiet damage inflation did to your purchasing power even when headline inflation looked better. Third, the housing affordability crisis that has turned home ownership into a distant rumor across the United States, the United Kingdom, Canada, and Australia. Fourth, the wealth concentration that is accelerating while you are being told to stay calm. And then we will go deeper than talking points. We will talk about the impossible triangle logic that governments keep trapped inside. We will talk about how tariff policy and rate cuts interact, and why courts and laws can force timelines that look like economic planning but behave like crisis control. We will talk about the most uncomfortable fact of all. Big money does not buy the dip the way you think it does. It stages narratives, it buys time, it rotates capital, and it uses you as the liquidity. You are not lazy, you are not stupid, you were just never given the real playbook. Let me start with the story that explains the mood in markets right now. In early 2026, the Fed signaled another move. Markets reacted like it was a release valve. Stocks bounced, credit spreads tightened. Investors celebrated the idea that borrowing costs were about to fall again. At the same time, there was political noise about tariffs and trade policy, and there were legal battles about whether certain trade measures were valid. You heard analysts say the economy is getting support. You heard talking heads say inflation is under control. You heard them reassure you that this cycle is different. But the market does not care about reassurance. It cares about one thing: which pain gets postponed and which pain gets transferred. Picture this. You are working two jobs. You have a calendar full of due dates. Your car insurance renews and costs more than your monthly grocery bill used to. You look at your bank statement and realize that the money you earned in 2019 would have covered the essentials in a way it simply does not now. You are not imagining it. According to Federal Reserve data and multiple inflation measurement comparisons, real purchasing power for many households never recovered to pre-2020 levels even after official inflation cooled. The math does not care how optimistic you are. Now picture what happens when the Fed cuts rates. In theory, lower rates stimulate borrowing, spending, and investment. In practice, lower rates also change the relative value of cash, bonds, and risk assets. When policy shifts, capital reallocates. Some borrowers benefit, some refinance, some businesses expand. But the biggest beneficiary is usually not the household with a paycheck. It is the capital owner who already has assets to reprice. And here is where the impossible triangle comes in. Governments want three things at once: low inflation, stable economic growth, and competitive international trade. But the policies that drive those goals conflict. If you crank tariffs, you raise prices on imported goods, which pushes inflation upward. If you keep rates low to protect growth, you increase the risk of inflation reappearing. If you try to do both simultaneously while pressuring trade flows, you end up forcing someone to pay the bill. So the real question is not do they cut rates? The real question is who do they protect and who do they sacrifice? They sacrifice you in the simplest way possible. They sacrifice you through the slow transfer mechanism. Your wages lag, your savings lose purchasing power. Your housing becomes financially unreachable, your retirement becomes more uncertain, and the market does not even acknowledge your suffering because stocks can rally while your life gets smaller. Now we zoom into the 2026 environment where this feels extra cruel because you are not just dealing with economics, you are dealing with disruption. AI is replacing entire categories of middle-income work, not in some futuristic sci-fi way, in a measurable way. Customer support, basic underwriting, drafting, data entry, entry-level analytics, even some parts of software development where you used to be told, learn to code and you could compete. In 2026, AI can write decent code, draft compliant documents, and automate workflows that used to require a team of humans. The uncomfortable debate about a useless class is not philosophy anymore. It is employment statistics, hiring freezes, and job postings that vanish after one upgrade to a tool you were told was just productivity software. So you have two pressures now. Your income is under threat, and your living costs are under pressure, and then the government tells you to trust the next rate cut. But rate cuts do not automatically fix household cash flow. They fix capital pricing. They fix the valuation of assets. They lower the discount rate that makes future cash flows look more attractive. That helps the balance sheets of firms holding financial assets, it helps the owners of those firms, and it helps market liquidity. It does not automatically help the person renting a two-bedroom apartment who is being priced out by a housing market that has detached from wages. Housing is the clearest example of the disconnect. Across the United States, UK, Canada, and Australia, housing prices decoupled from wage growth. The average household income did not grow at the same pace as home prices. The result is a generation that does not build equity through ownership. It builds rent obligations through long-term commitments. Rent is not just a bill. Rent is a forced inflation tax. When rates drop, landlords sometimes reprice faster than wages recover. And if prices keep rising due to structural supply constraints, refinancing does not help the renters at all. It can even make the market hotter by encouraging speculative demand. And then you add inflation's long tail. Even when headline inflation falls, the cumulative damage is already done. If your grocery basket went up and your wage did not keep up, you still feel it. The cooling of inflation on paper does not erase the lost years. Think of it like this. Imagine you owned a time machine, but it only rewinds your bank statement headlines, not your actual expenses. That is what many households experienced. A narrative change, not a recovery. Now let's connect the dots the way markets do, with cold logic. In 2026, there is a concept people hear about but rarely understand in real terms: the relationship between tariffs, inflation, and rate policy. Tariffs are taxes on trade. If the government taxes imported goods, import prices rise. That can feed into consumer prices. If rates are cut while tariff pressure remains, you have a situation where one policy tries to ease financial conditions while the other keeps pushing prices upward. That is the economic tension. But politicians cannot admit a simple truth: they cannot force the world to pay the price of a policy while pretending their citizens are insulated. The bill shows up somewhere. It shows up in consumer prices, it shows up in supply chain disruptions, it shows up in business margin compression, and it shows up later in fiscal stress. And that fiscal stress matters more in an era of debt. Global debt has exceeded $300 trillion. That is not a slogan. That is a scale that changes how policy behaves. When governments are heavily indebted, they cannot tolerate long periods of financial instability, and when corporate and household debt are stressed, the system responds with liquidity and asset support. The Fed can cut rates, it can signal, it can influence, but it also knows something you rarely hear on TV. If markets believe the economy is breaking, the dollar can seize, credit can freeze, liquidity can drain. So when you see rate cuts paired with political and legal tariff uncertainty, you are not watching a neutral economic adjustment. You are watching crisis choreography. The system is trying to keep capital calm long enough to prevent a broader repricing. Now we arrive at the part that makes you feel lied to. People heard a story that sounded comforting. In the recent past, the Fed cut rates to prevent inflation from spiraling, and in the meantime, tariff disputes were resolved and major investors supposedly became bullish. Some analysts pointed to famous names as proof that things are okay. They said even the most cautious investor is buying again. They presented it like a signal that markets bottomed and the smart money is confident. But you need to understand how these signals work. Famous investors are not your personal fortune tellers. They are managing enormous portfolios in a way that also manages perception, liquidity planning, and tax outcomes. There is a reason these people are careful about how they buy. If you hold tens of billions in assets and cash equivalents, you are not going to deploy everything at once just because the narrative changes. You will allocate in chunks, you will hedge positions, you will sell something while buying something else because you are balancing risk and liquidity. You will sometimes buy to reassure markets while quietly reducing exposure elsewhere. And you will almost never follow a simple retail story like they bought a little so the bottom is in. Imagine a magician on stage. Their right hand reaches toward the audience, their left hand flips a card behind their back. Most viewers only look at the hand they can see. In finance, it is similar, except the magic trick is bigger and the audience is your retirement account. So when a billionaire buys a small amount of stock, ask what else they sold. Ask whether they moved assets into other buckets. Ask whether their cash levels changed. Ask whether they rotated into assets that behave differently under stress, like foreign currencies, commodities, and structured products. This is not conspiracy. It is portfolio arithmetic. Here is a micro story you can feel. Picture a 32-year-old nurse named David. David did everything the way he was taught. He paid bills on time. He avoided debt when possible. He put what he could into retirement funds. He watched interest rates rise and told himself it was temporary. When people started talking about inflation coming down, David felt relief for a few months. Then his rent jumped again. His insurance renewal shocked him. His grocery budget moved up like a staircase. He began skipping small expenses. Not the big ones, the small ones that used to be comfortable. He told himself, "At least my retirement investments are up." But his retirement account was not his life. It was paper value. It did not lower his rent. It did not buy his prescriptions. When markets rallied, David still felt poorer, because the essentials were rising faster than his income. Then he got laid off from a contract he had relied on, because the hospital replaced his scheduling workload with automation and AI tools. David tried to find a new job, and every job required new skills he could not learn in time while bills were due. That is what markets are doing great means for people like David. Markets can rally while your life shrinks. And that shrinking creates the desperation that makes you accept worse terms later. Now take that desperation and look at the policy side. If the Fed cuts rates because it is concerned about financial stability, it may be less about stimulating growth and more about preventing collapse. Rate cuts can be precautionary, or they can be rescue operations. The difference is the underlying diagnosis. Precautionary rate cuts look slow and measured. Rescue rate cuts happen fast and big because credit conditions and employment conditions are already deteriorating. The Fed is acting like a surgeon, not a wellness coach. In 2026, the policy tone has been cautious. Small cuts. Limited expectation of multiple cuts. That can be framed as they are preventing a downturn. But what if the economy is already in a downturn and they are only trying to keep it from showing too quickly? This is where you should be skeptical of the comforting narrative. Because the Fed is not a friend, it is a steward of financial stability under a mandate that includes maximum employment and stable prices, yes, but it does not protect households first. It protects the functioning of credit markets first. Households are collateral in the process. Now we escalate. Why would a system pretend to protect growth while quietly protecting asset values? Because the alternative is worse. If markets believe a serious recession is imminent, investors rush to safety. They sell risk assets, they demand liquidity. That triggers defaults and layoffs. Asset prices drop. And then the people who hold leverage get destroyed first. In other words, a collapse is not just a moral outcome, it is an economic chain reaction. So what does the system do? It stabilizes asset prices, it stabilizes credit, it tries to buy time, but you cannot buy time without costs. Those costs show up as delayed wage growth, continued housing stress, weaker labor conditions, and aging pension plans that do not keep up. And in many countries, retirement systems are already fragile, underfunded pensions, delayed social security claims, higher retirement ages, more dependence on individual savings that get hit by inflation. In the United States, many households are forced to delay retirement because benefits and savings cannot cover the gap. Social Security trust fund projections have created long-term uncertainty, and when you combine that with underfunded corporate pensions in some sectors, you get a future where people work longer not because they are fulfilled, but because the system failed to fund the promises. Now add climate-driven economic disruption into the mix. When insurance markets collapse or premiums spike after disasters, homeowners face forced reallocations. Tenants face migration pressures. Municipalities face fiscal stress. Supply chains are hit by extreme weather. That means costs keep rising even when policymakers claim inflation has cooled. So even if headline inflation falls, your lived inflation can be high and sticky. Now, in this environment, AI disruption hits your employment. Housing hits your stability. Inflation hits your purchasing power. Debt hits public budgets. And policy tries to keep financial markets smooth. It becomes clear why the rate cuts are not the fairy tale people want. But you still need one more layer of understanding, and this is the layer that changes how you interpret every good news headline. When governments face a trade policy constraint like tariffs, and they face a monetary policy constraint like inflation, they often choose a third option. They choose the option that keeps capital calm while transferring the pain to labor. It is not always done explicitly. It is done through mechanisms, labor market classification, unemployment measurement, fiscal priorities, and the timing of policy effects. Let me explain with the kind of detail that destroys the comforting illusion. In the United States, unemployment statistics are calculated in a specific way that can obscure real labor distress. Not everyone who loses income gets counted as unemployed immediately. People can work a single hour and still not be classified as unemployed. People who stop searching can fall out of the labor force. People who are pressured to take unstable work can appear fine while their real income collapses. So a rate cut can happen while the labor market is weakening, but the headline data looks tolerable. It is like checking your pulse while the patient bleeds out slowly. Then you look at people living on the edge. In large cities, homelessness becomes visible, not because it was never there, but because policy and income pressures have reached a threshold. When unemployment benefits run out, when long-term job search fails, people move from unstable housing to permanent instability. That is not an opinion. That is a pattern you can observe. So when the Fed cuts rates and says it is preventing collapse, you should ask a sharper question. Are they preventing collapse in the real economy, or are they preventing collapse in asset prices and credit? Because those are not the same thing. If the policy is rescue-oriented, the goal is often to stop financial damage from spreading. In rescue mode, the Fed can also become more aggressive in liquidity operations, bond purchases, and communications that keep yields from spiking. It is about stopping a repricing. If the policy is precautionary, the goal is to soothe overheating markets while inflation stays manageable. In that case, rate cuts are small, and the Fed expects slow changes. In 2026, when rate cuts are small and inflation threats persist due to tariffs and supply chain frictions, it often signals that the system is buying time, not fixing the foundation. And the foundation is exactly what you feel: employment insecurity, wage pressure, housing stress, and inflation's lingering harm. Now let's revisit the tariff piece, because this is where people get tricked. Legal decisions about tariffs can create deadlines and timelines. Courts can rule that certain tariffs were imposed unlawfully. That does not automatically mean the policy disappears. It means the government must follow process and potentially repay amounts collected, depending on the legal outcome. And repayment is expensive. It hits budgets. It can create pressure to print more money later or to cut spending elsewhere. So the system may appear to resolve uncertainty, but the underlying fiscal stress remains. At the same time, governments often need tariffs as leverage for negotiations. They may comply with court requirements in form while continuing the strategy in substance through new frameworks or different measures. This is why tariff headlines can change while your cost of living does not magically improve. If tariffs are delayed or restructured, consumer prices can remain high. If imports are constrained and domestic production cannot scale quickly, prices can stay elevated. So when you hear tariffs might be removed, you should ask what is actually being removed: the specific tariff line item, the mechanism, the timeline, the enforcement, because even a small delay can keep supply chain costs high for a long time. Meanwhile, the Fed is cutting rates and markets are rallying. You are watching two different stories at once: your cost story and the market story. Now here is the cliffhanger you should not ignore. What happens when the system needs both lower rates and stable trade policy, but it cannot achieve both? What happens when it cuts rates but cannot remove tariff pressure fully? What happens when inflation remains sticky in certain categories but yields still need to fall to keep asset prices from cracking? The answer is ugly. It will keep loosening, but it will also keep transferring risk. It will transfer risk from balance sheets to household budgets. It will transfer risk from corporations to workers. It will transfer risk from the winners of the market rally to the losers who did not own the assets. And if you do not see that transfer, you will keep mistaking market gains for personal safety. Now let's talk about the asset rally itself, because in 2026 it can feel irrational. Stocks hit highs while layoffs happen. The Nasdaq can look strong while your neighborhood feels weaker. Crypto can surge while the average person cannot pay